Okay, everyone, we're going to go ahead and get started. I want to say first, just thank you. Thank you so much for being here. Welcome to this presentation. I hope that you are happy and healthy and safe wherever you are. My name is Eric Thompson. I am your host. I'm with Windermere Real Estate. You see our two esteemed guests here on your screen. That's Bill Humphrey with New Direction IRA. That's James Wedding with First Bank. So both of you can just say hi.
Good morning, everyone. Thanks for attending.
Yeah, thanks for having us.
Absolutely. Well, thank both of you for being here today. We so appreciate it. So everyone watching needs to know that both of these people are experts. You're going to learn from these experts. Bill is the expert on how to set these up, how to set up owning real estate within an IRA. James is an expert on how to have a loan on a property on an acquisition like this, right? So you're going to learn a lot from both of them. I'll be here to facilitate. I'll be here watching the questions as they come in. And speaking of that, as a way to get warmed up, just as a way to practice, to make sure also that you can hear us okay, would you mind just typing in a note using the question function of GoToWebinar, so you can find the spot where you can type in a question. If you wouldn't mind just typing in just a quick hello, or just let us know that you can hear us all right, that would be super helpful. And I see those comments rolling in. Thank you for that. So appreciate that. So that's exactly how you would type in questions if you have a question as we go along. So here's what you're going to get out of today. So we're here for no more than an hour. What you're going to get out of today, guys, is you're going to get a lot of clarity, right? You're going to get a whole lot of clarity about how this works. A lot of you have never heard about this, or maybe you've heard a little bit about it, but you're not quite sure how you would structure something like this, how you could do this. You're going to get a lot of clarity about that. You get clarity on how to have a loan for this kind of a property, this kind of ownership, this kind of an acquisition. So you will see exactly how it works. You'll see exactly what to do next. What we're finding oftentimes is that people want to diversify, and they want to own more than just stocks or more than just mutual funds within an IRA. And people are pleasantly surprised to hear that, yes, indeed, you can own real estate inside of an IRA. I'm someone who does this myself. I own two properties within my IRA. I work with both of these companies represented here, New Direction IRA and First Bank, on those properties, and it works splendidly. It works so well. So I'm a testimonial here. I'm someone who does this. It works really, really well. So we appreciate everyone who's engaging with this, either live or watching the recording. What we're going to do is, if you have questions, feel free to type them in. But what we're going to do is we're going to take questions at the very end. And again, I'll be here to facilitate those questions. And what we're going to do now is we're going to turn it over to Bill. And Bill, again, thank you for being here. So appreciate it. And I'm going to put your slides up on the screen, and Bill, you can take it away.
All right, Eric. Well, thank you for inviting us. Again, I'm Bill Humphrey from New Direction Trust Company, and a long time ago, we, Catherine Wynn, the co-founder of New Direction, and I were out on a run somewhere East Boulder, and she happened to ask me a question, which, me being a CPA doing tax returns for years, never had it asked. And it was such an interesting question, which was, why can't I own real estate in my IRA? And so that single question started me doing research and her doing research, and lo and behold, we discovered that you can. And if you click the slide there, Eric, what we ended up doing was starting New Direction Trust Company, which is a custodian holding assets for IRAs, but we're not an advisor. So we want to make sure everyone realizes we're not telling you to go buy real estate in your IRA. It's entirely up to you and your own advisors. But what we do is help you facilitate that and do the tax reporting and the record keeping and so forth. But what we discovered was that most people with their IRAs, they invest in what is offered on the menu from Fidelity and Schwab and all those folks. And that tends to be, and almost exclusively actually, is Wall Street assets. So like Eric was mentioning, stocks and bonds, mutual funds, that sort of stuff. But if you just look at public assets, you're missing a whole lot of other assets. So Eric, if you would, the there's a whole world of assets that go beyond those Wall Street assets. And real estate is probably the most popular one because people have invested their own money out of their pocket into real estate, and they've seen returns from it, and they've seen the growth of those assets, and they want that same kind of growth with all their money. And lots of times, most of the money for investing is in the IRA or some other tax sheltered account. So what we discovered was that we didn't know, and this was around 2000, this term self-directed IRA started emerging. And we said, what is that? And much like Eric was mentioning, most people don't still know 20 years later that a self-directed IRA, Eric, if you would, is just a marketing term. But it represents that the self person, you, for your own IRA, can be the decision maker for all the investments in that account. And that really gives you a lot of power, because rather than going to a list that Fidelity has provided, you can go and look for any asset that you want. And if you want to buy real estate, call Eric or Windermere and say, hey, I've got this money in my account. I want to buy something other than stocks and bonds. How do I do that? And lucky enough to have an experienced investor and a team that understands it, it's not really any different than buying real estate with your personal money, except for it's a separate account that we like to call it Uncle IRA. So Uncle IRA has the money. Uncle IRA, go ahead if you would. The idea is that Uncle IRA is the investor. Uncle IRA has the money. Uncle IRA is going to make that investment with his own money, but you're going to tell Uncle IRA what to do. So you're going to tell Uncle IRA what to buy. You're going to tell Uncle IRA how to paint the front walkway and what the tenant's going to be and how much rent you're going to charge. So you're really the decision maker for everything. That's the self and self-direction, because you are deciding everything. And that's a great thing and a bad thing at the same time. It's a great thing you get to make all these choices, but people are often not used to making all those choices for their IRA. So it's a little different. You're in charge. You have to make all those decisions, because we're not an advisor. We're not going to call you and tell you that, oh, that rent's too low, because we're just following your instructions. So important piece of a self-directed account is you're in charge and you make all the decisions related to that account. So if you would, one more, most people haven't heard about these plans because the folks that typically custody plans like IRAs, they also sell assets to those IRAs. So they want you to buy the things that are on their list, because that's how they make their money. So if you have your IRA buy real estate, they're not involved and they're not going to make any money. So they never even talked about it. So that question that Catherine asked me back in the day was one that her experience was working with the Wall Street folks, and the Wall Street folks said, you can't do it. They skipped the with us piece, that you have to find a different custodian to do it. So that's where New Direction comes in, is we allow you to buy whatever it is you want, and particularly for real estate, which is probably our most popular asset. There are other things, if you would, Eric, anything that you've seen as an investment could be acquired by your IRA. So all sorts of things, including the stock market. So you're not excluding the stuff you've already bought in the past, you're just adding to the number of possibilities that you have. So of course, today we're going to talk more about real estate in specific. So what kind of real estate can you buy? Almost anything. So our clients have done choices of single family houses, which is easier for an IRA to buy because it costs less money, but we've also seen people buy apartment buildings, they would buy condos, commercial property, private property, almost anything. Eric, if you would. And that can expand way beyond what you're used to. Foreign property, raw land, anything that you've seen as an investment can be acquired by your IRA.
So Bill,
Eric, yes.
Bill, so the way to think about New Direction is you're a custodian, just like a Charles Schwab or Edward Jones or whomever would be a custodian for an IRA that's owning stocks, bonds, mutual funds, New Direction is a custodian and for an IRA that owns real estate. And so the Charles Schwab, Edward Jones, that they're not set up to have real estate inside of that investment where you are. Am I saying that right? Am I understanding that right?
Yes, exactly.
Okay.
So each IRA represents a bucket of money, cash, and assets. So with Schwab, the only thing in the bucket is some cash and stocks and bonds. With our bucket, it's whatever you decide to put in there. So starting with cash, usually you can buy real estate, you can still buy stocks and bonds, but whatever it is, you're the decision maker. So you're not going to go and find a list that includes 123 Main Street. You have to go out with you, Eric, or one of your associates and find that property, and then the IRA buys it.
Perfect.
Okay, so the next slide, an important leveraged and unleveraged, and one of the nice things about having First Bank here is that most IRAs can't borrow because those assets, those public assets, are so varying in value that the bank won't lend on them. And with real estate, like most of us who've bought real estate in the past, we used a lender. So First Bank is one of the few lenders in the country that understands how it works and is able to offer you, your IRA or your Uncle IRA, the ability to borrow money to buy a bigger piece of real estate. Totally optional, but it is an option that most people never even thought of for their IRA as well.
Perfect.
Okay, next slide, if you would. So when we always talk about IRAs, because it's easiest to just say IRA, but all this set of rules applies to all of these plans, including employer plans like 401ks, STEP IRAs, simple IRAs, traditional Roth IRAs, as well as health savings accounts. So all of these accounts follow the exact same rules. And potentially those, if you have a multitude of plans, they can all go together and put their money into a common asset. So we'll talk a little about that in the future. Next slide, if you would. And so how does your IRA get to buy something? Well, of course, the easiest one is just to have your IRA own it outright. The title on the IRA deed will be New Direction Trust Company for the benefit of your IRA. If your IRA doesn't have enough money or you want to diversify into more assets, you can always bring in partners. Those might be IRAs, those might be non-IRA funds. And another way a lot of people think about real estate is to be a lender. So some of these properties might be hard to get a loan for. Your IRA could actually lend to somebody else or somebody else's IRA to help them buy the asset. So lastly, equity. There are companies that buy properties. Your IRA can be a shareholder of that company, just like a share of IBM. You could buy a share of 123 Main Street LLC that owns that property. So all sorts of options. The nice thing is that Uncle IRA is an investor, and Uncle IRA can buy whatever he can afford or whatever he and his friends and other business associates or family members, even in some cases, can come together to buy an asset. And Uncle IRA is just an investor. Now, there are a couple of rules, and the primary one is no self-dealing with your IRA. And that short story is you can't have a transaction with your IRA. So if you have your Uncle IRA buy the condo in Maui, could be a great investment for Uncle IRA, but you're not allowed to go and use that asset. So you can't go and stay in Uncle IRA's condo, and you can't have a transaction where you buy something from Uncle IRA or vice versa. And there's some other details about how those what are called prohibited transaction rules work, but we won't spend much time on it. But just remember, this asset is an investment. It's not for you to use until maybe in the future, once you retire and take the asset out of your IRA. But in the meantime, it's just like a share of IBM. It's just an investment. You're managing it more intensely than IBM shares, but it's still just an investment for your plan. And one more slide. It's not just you that can't have transactions, it's you your spouse, ascendants and descendants. So all of that set of family members cannot have a transaction with Uncle IRA. But folks out to the side, aunts, uncles, sisters-in-law, all those folks are not in the prohibited transaction disqualified person list, but you still have to have a reasonable transaction with them. So you want to have your cousin rent your condo in Maui, he could do that, but he'd have to pay fair market rent. He can't go and stay for free. So that's sort of the hands off of Uncle Ira's stuff until you get to retirement age rules. And so the next slide, if you would, Eric. So why would you go to the effort of setting up a self-directed IRA and buying real estate and taking on this responsibility of doing the management or hiring someone to do the management and all that stuff? It seems like a lot of work. And it is more work than buying shares of IBM, but it gives you so much control over that asset. And you can keep your eye on it so much better than you can affect the value of IBM shares. And you can have mix and match different assets as time goes on. You might sell one piece of real estate and buy another. You might sell one piece of real estate, go back to the Wall Street assets. All of it is under your control. So if you are a take charge person and you want to grow your retirement value in the future, then a self-directed account is the opportunity of a lifetime to get in there. And like Eric was mentioning, diversification outside of Wall Street is so much more potential, both for risk and return. So you're getting to be able to take more risk, and it might not be more risk because you've been investing in real estate for years, you know how it works, versus someone who hasn't been doing it. So you're getting to use your own investment knowledge to make decisions that are going to benefit your retirement future and increase the value of Uncle IRA's bucket in the long term.
Hey, Bill, I can speak
So
a little bit to this, more to this personally, and we hear it from our clients. What's coming up for me first number 4, I got to a place where I was just tired of the big wild swings that Wall Street would take, and also got tired of kind of a game that I didn't completely understand. You know, what happens on Wall Street, it can feel like an insider's game. It can be very complicated. And so I wanted to diversify. I didn't want to take all of my money out of the stock market, but I wanted to diversify. I'm obviously a big believer in real estate. So that also takes me to number 1. What I appreciate is that if I wanted to, I can drive within a few minutes from my home to the rental property that I own inside of my IRA. So I can look at it, point to it, walk inside of it if I want, meet my renters. You know, it's very hands-on. And then as I look at the returns that I've gotten on it, because they have loans, the return on the down payment that's been realized because of the appreciation that we've seen in our local market during the years that I've owned these properties, it is significant. So what I'll share is that every day I thank my lucky stars for my real estate inside of my IRA. And I would imagine you hear very similar stories from your clients.
We do all the time and they're across the board conservative, very aggressive, and in between. And some use loans, some don't. But real estate tends to be the solid returner of assets. Sometimes not spectacularly, but steadily over time, as probably one of the best long-term assets that our clients have seen and used. And it's great to see them take their IRA that they've never really thought about as an investing tool and put it to work for their benefit, using their own special, unique experience. And like you say, the ability to go and take a look at it is very comforting.
Yeah. Okay. Would you like the next slide?
Yes, please.
Okay.
Okay, so how do you do it, actually? So the first thing is you have to have a self-directed account. So that you can go to ndtco.com, which we'll show you here in a second, and set up the account. So you're creating an Uncle IRA. And then Uncle IRA starts with no money, so you need to move funds from wherever your existing IRA is into Uncle IRA's account. And most people do that by liquidating the stocks and bonds and sending cash over. You can actually move those things in kind and then sell them as you need them on our side on the New Direction side. But most people, just for simplicity, want to move cash, get it there ready to go. Once the money's in there, and of course, these are just regular old IRAs, so all your contribution rules apply. So you can contribute, I think, $6,500 a year to the IRA. Most of our clients have plans that used to be at a business, usually a 401k that's been rolled into their IRA to get the dollar amounts to be bigger. And then once the money's there, then you decide what you're going to buy. And that's where the self-direction part pops in, as you call Eric and say, hey, what's looking good and potentially a good rental. And it doesn't matter whether it's an IRA or not, the return of the asset is going to be the same. So deciding what you're going to buy, are you going to get a loan? Are you going to bring in other partners? What's it going to look like cash flow wise? So run the numbers and see what makes sense. So that's sort of it's not as hard as you think. The hardest part is deciding what you're going to buy. And that's where folks like Eric can help you deciding and looking and analyzing markets and potential returns and what the rents are going to be. So be sure to, no one's going to tell you, at least no one from the New Direction side is going to say it's a good idea or a bad idea. It's all up to you and your own realtor and other advisors, accountants, lawyers, if you want to talk to them as well. So that's sort of the quick and dirty 15-minute version of how it works. Lots more details. You can see extra info on our website at ndtco.com. We have some other educational materials about real estate investing and how it works with your IRA that you feel free to download or send us a question on our website. So with that brief intro, Eric, I'll turn it back to you. And
perfect, Bill. Thank you. I'll quickly say this is exactly what I did. So I decided I wanted to do this. I had a 401k from a previous employer that had been converted to an IRA. So with New Direction, I set up the new account. So now the new account, the new shell is set up. So then I sold the mutual funds that were sitting there within the IRA with Edward Jones. So now it's cash. And I took that cash inside of the Edward Jones IRA, moved it to the New Direction IRA, so it's still within the IRA shell. And then now that cash is sitting there, and then I went out and I evaluated properties, and then the IRA goes out and makes offers and goes through the same purchase process as any other buyer. So it's pretty simple. It's just follow these steps. So Bill, that was great information. We will have questions for you at the end. There are a couple that have been typed in. So thank you everyone for typing in those questions. And what we're going to do is we're going to save those for the end, but feel free to type them in. I can see them here on my screen. We'll get to those. And with that, by the way, there's the website URL and also the email. It's ndtco.com, newdirectiontrustcompany.com. You can see the email address. Bill, thank you again. So what we're going to do now is hand it over to James. So James, you're going to walk us through how to have a loan on these properties. So you don't have to pay cash. You can have a loan. You're going to tell us all about that. So thank you, James. Take it away.
Absolutely, Eric. Well, thanks again for having me. And as Eric said, my name is James Wedding. I'm a vice president at First Bank, and I've been here for about 6 years. And I'm sure a lot of you have heard of First Bank before, or even worked with us on a transaction. But just to give you some brief background on the bank, we're a full-service bank, and we offer all types of loans, including business, commercial real estate, and mortgage loans. And we're a full-service mortgage provider, but I think people know us best for our portfolio mortgages. When I say portfolio mortgage or portfolio loan, that just refers to a loan that's not sold on the secondary market. It's retained by First Bank. And one of those mortgage lending products is a loan that's directly to your IRA that allows you to purchase real estate. So as Bill and Eric mentioned, not only can you self-direct funds from your IRA into real estate, but this also allows you to leverage your retirement to be able to buy that real estate and really improve your returns. So Eric and Bill, as I'm going through this, please feel free to stop me with any questions or if you have any additional commentary to add on anything. But hopping into this, when we look at these loans, there are three main items that we analyze. So we want to make sure that the underlying plan participant meets certain qualifications. So these are going to be cash flow metrics, liquidity, minimum credit score, etc. We also want to make sure that the plan meets our qualifications, that it's set up correctly. And finally, we analyze the property and ensure that this meets certain leverage and cash flow metrics, and we'll discuss that in more depth as well. So would we first take a look at this, the plan participant, also called the plan sponsor. So that's you, that's the owner of Uncle IRA, as Bill was talking about. These loans are made directly to the IRA, and there's no personal guarantor. So anytime you've gotten a traditional mortgage, you've had to sign on there. But in these cases, it's just going to be that IRA, and the bank is relying completely on the property as our source of repayment. We do, however, just have some guidelines that we want the plan sponsor to be able to adhere to. So we'll collect a loan application, we'll pull a credit report, and we'll analyze your personal debt service ratio. And this is really similar to your debt to income ratio, and that's probably a metric that you're more used to hearing. We also look at your net worth, and specifically we're looking at your liquidity, as we want to make sure as the plan participant, you're able to contribute to the IRA if there are repairs, vacancies, or other cash flow needs that arise. And in regards to credit score, we're looking for the plan participant to have at least a 680. And then also as part of the transaction, we'd like the plan participant to set up a banking relationship with First Bank as well. So the next thing that we analyze is the retirement plan itself. So the self-directed retirement plan should be set up prior to application and going under contract. And as Bill said, that rollover can take a little bit of time, so we like that to be done prior, just so we're not holding up the transaction. There's a couple different structures. So only single member spouse plans are allowed. Separate plans can partner together to purchase a property, and this is getting a little bit into the weeds and something that Bill and his team and your custodian will be able to talk you through. Kind of the differences and what's possible to purchase a property. We do have our attorneys review the plan documentation just to make sure we have a second set of eyes on the structure. A big thing that we talked about, but just making sure you have adequate post-close liquidity in your plan, because if you think about it, there are restrictions on what you can put on annual contribution limits in your IRA. So if you don't have adequate funds, it could force you to have to refinance or even sell the property if you don't have adequate funds. So we say a good rule of thumb is to have 6 months of payments and reserves for post-transaction liquidity. And just like with a traditional mortgage structure, we can do a refinance, purchase, cash out refinance as well. If you don't mind going to the next, yeah, perfect, thank you. And so this is the item that really wanted to take the deepest dive into our property qualifications. We lend on all types of properties, as Bill was going over, single family homes. And when we say 1 to 4 family homes, so that's going to include, a condo, townhome, duplex, triplex, and fourplex. And we're really going to focus on the residential side of this for this presentation, but just know that we can do commercial property loans for this as well, and those just look just a little bit different. The properties do need to be located in our trade area. So our trade area is going to include from Fort Collins to Colorado Springs, all along the Front Range, select mountain communities in Colorado, as well as the Phoenix and Scottsdale metro area in Arizona, and Palm Desert, California. The maximum loan to value that will go on these is 65% loan to value for a purchase and 55% for a cash out refinance. And while these are the maximum loan to values that we can extend up to, we really need to look at these from a cash flow basis as well. And that's what we're going to jump into on this next slide. So in order for a loan to qualify, the property must create positive cash flow. And the reason this is so important is there's no personal guarantor, so the sole source of repayment for the bank is the subject property. So we want to make sure that the property has positive cash flow and is able to sustain itself. One question that we get a lot is, how are we determining this rental rate? So we order an appraisal, and we rely on the appraiser to provide a schedule of rents for comparable properties, and they come up with what they deem as the market value. So once we have that market rental rate, we'll discount that, take a 25% expense ratio or 75% of that gross number. And this is discounting for things like vacancies, improvements, utilities, etc. And that discounted rate must be able to service the mortgage payment entirely. So if you look in this example, we have a $300,000 purchase. The plan is putting down 35%, so that's leaving us a mortgage of $195,000. And we look at the total payment, and this is going to include principal and interest, taxes, insurance, and HOA if it were applicable. And in this scenario, you can see that the cash flow worked out great. But I think as a lot of you investors have probably started to encounter in Fort Collins, maybe having to put a little bit more down to kind of make those numbers work. So on this next slide, I kind of want to show you a cash flow example where the 35% down didn't work and we had to put a little bit more down. So if we look at this scenario, this is a $400,000 purchase price. We're starting with 35% down. You can see our payment is $1,657. And in this case, the down payment is not enough to create positive cash flow. It doesn't cover the mortgage payment. We have a deficit of $157. So what we do is we have the IRA right size or put a little bit of extra money down. So in this case, it was $31,500 in order for the discounted rents to service that payment entirely. And this is something that your loan officer is going to go through with you in detail, just so you're comfortable with this. And one other item that you may notice is this rate is just slightly higher than a traditional investment property loan. And the reason being is, there's not a personal guarantor. And I know I've said that a couple times, but it really does affect multiple sides of the transaction. I did want to mention that the rates right now are hovering about 4%, so a little bit lower than what you're seeing in this PowerPoint. If you want some exact rate scenarios, please feel free to reach out. We'll be happy to provide those.
Hey, James, can I interject a couple things?
Absolutely.
First, a question just to make sure. I assume the answer is yes. We can send out these slides?
Absolutely, yeah.
Great, because I'm guessing people will want to have these slides. What I would say is that if there's a catch, that with something like this that sounds incredible, it is incredible. It's such a great way to diversify, to have control. So sometimes that begs the question with something so good. So what's the catch? The catch, from my standpoint, is really this on this previous slide. The catch is that it's a little harder. Maybe harder isn't the right word compared to traditional investment loans. So you're putting more money down than you would be on a more traditional investment property. So typically investment properties, we're seeing a minimum of 25% down. This is 35%. The next catch would be this 75% aspect. So they're going to take what the market rent would be, they're going to discount it, look at 75%. So it's got a cash flow even at 75% of the market rent, which means that you may have to put a little even more down than that, and then the rate is going to be a little bit higher. Now the trade-off is you get diversity, you get control, you get leverage, and I mean, from my standpoint, James, all these things make sense, all these qualifications and stipulations that you have, in that there is no personal guarantee for you, that it's only the property. So of course you would have to incorporate these qualifications and stipulations to have this make sense. So, if anyone's wondering with things like this, so what's the catch? That's really the catch. You're gonna put more down maybe than you would on a typical investment. You're gonna be faced with this discounting the rent, 75%. It's got a cash flow, and you're gonna pay a slightly higher rate. But my goodness, to have a rate around 4% on an investment property is incredible based on history. So thank you, James, for letting me interject that. I thought that would be helpful to the people listening. Do you want me to go one more slide, or you want to talk more about this slide?
Yeah, one more slide, and thank you for that. That was a good explanation.
And if I could just tack on to that, one other thought is remembering that when this money was in Wall Street, everything was 100% down because there was no lending allowed. So rather than comparing it to the 25, sometimes we tell people compare it to 100.
Yes.
Because with Fidelity, they're not going to let you borrow any. So suddenly you're able to have 3 times the buying power that you did when you compared to what it was at Wall Street. So
that's a great point. That's a really, really good point. So it's almost not fair to compare it to traditional investment lending. You're really comparing it to where the money was before, where you had no leverage at all, and all kinds of regulations, stipulations, many of which are so hard to understand, and we're playing this game that seems like an insider's game sometimes. So that's a really good point, Bill. Thank you. Okay, James, take it away.
Perfect. Yeah, so the next item I just wanted to talk through is, what does this look like? What are the details of the transaction? And it functions a lot like a normal mortgage. So it's going to be a pretty familiar process if you've bought in a home before. We can issue a pre-approval plan letter, for the plan. And what we'll do is help you run some cash flow scenarios so you feel comfortable with how that number is going to be calculated. And then we can meet about a 30 to 35 day closing time frame. I will say with one caveat, these are usually scheduled as a mail out closing depending on the actual structure of the product, because the custodian will actually execute the loan docs on behalf of the retirement plan for a lot of structures. So if this was the case, what this will look like is we'll get all of the loan and title documents, and we'll first go to the plan participant. So that's you as the IRA owner. And you're going to review all the documents, and you would actually sign under each of the signature lines, read and approved. And then all of these documents are then mailed to the custodian to actually execute, and then to the title company. So given the amount of coordination that takes place from all parties, it really can be beneficial just to have a couple extra days for closing depending upon your loan structure. And this is something that we'll identify ahead of time and work with your agent to make sure that there's plenty. The closing costs for the program, it's pretty standard. So you're going to have your third-party fees, you're going to have your appraiser costs, you're going to have your title. Origination fees are going to be between 0.5% to 1.5%, depending on the rate option you select. And then the only kind of out of the ordinary fee is a $750 fee for an attorney review. And that's just since the plan documentation is reviewed by our legal team. On this next slide, if you don't mind going, Eric. I know on our side, this was a lot of information, so I just wanted to recap kind of two major takeaways. And I would say liquidity in the plan is key because you have your limited contributions annually that you can make to your retirement plan. And then two, just making sure that not only are you thinking of the loan to value, but the cash flow component and how important of a role that plays in determining our loan amount. And finally, I'd like to mention that we're only experts on the loan side of this process, and you got to have a good real estate agent, a good custodian, a good accountant giving you advice along the way too. We've kind of seen some horror stories in the past using lesser known custodians, so we highly recommend New Direction or a really reputable custodian because they're a vital part of it. And as Bill said, they're actually on the deed of the property, so you're pretty tied to your custodian when you're entering that relationship. So it can be pretty difficult to switch. So making sure you have a good person on your team like New Direction is key. And Eric, that's really all the information I had. I don't know if you had any questions pop up, or Bill, if you had anything additional that you wanted to add on.
Let's see. So we've had several really good questions come in. So I'll show this slide real quick, James, so people have your contact information in case they want to reach out to you to learn more about how to have a loan on these kinds of properties. Yeah, speaking firsthand, you all do an incredible job with these IRA-owned properties. And I'll tell you one other thing that I appreciate about both of these companies is they're local. So New Direction is just right down the road in Louisville, and First Bank is all over Colorado. So I'm someone who enjoys working with local companies. So it's pretty neat that the two experts on this happen to be located right here in our own backyard in Colorado. So let's get into the questions. There's some really good ones that came in. And you're welcome to type in an additional question, or if you haven't typed one in yet, feel free. I can see it right here on my screen. So as you see me look down, that's me looking down here at my question toolbar. So here we go. Is this an option when you are past retirement age? Maybe Bill, why don't you take that one? Is this an option when you're past retirement age?
Absolutely, and that actually is a great advantage, that you have the money in Uncle Ira's bucket and you retire, so you're not putting any more money into Uncle Ira's bucket, but still you want Uncle Ira to have investments that are growing. So we have people that are well past retirement age that are still investing. They are looking oftentimes for cash flow more likely than some younger folks, because they need to start taking distributions out. And it's easiest in cash, but yes, this is still an option.
Great. Thank you. This next one also for you, Bill. If I have an investment property that generates income over time, so it's generating cash flow, does New Direction give the ability to invest that cash in stocks or other investments, or move it back into an IRA that allows that? I'm assuming the cash will accumulate over time, but not necessarily at the level that would allow for investment in more real estate. So I think bottom line, if this is kicking off cash is accumulating within the New Direction IRA, what can you do with that money?
Well, the great thing is that, so with Uncle Ira's bucket, you've got your real estate and it's producing cash, which is staying in the bucket. You just need to decide what other investments you want to make. So including doing stocks and bonds, we have people that do all sorts of things, including notes. So it doesn't have to just be one asset. So if you've got extra money, you can have Uncle Ira lend it out, or make a other investment in a small dollar property or a startup company, anything that you decide.
Great. This same person had a follow-up asking, what happens when you need to draw down? She says, I'm assuming you can sell the property and then draw down the cash over time.
Yes, that's certainly an option, or a lot of these are going to be cash flowing, that are, the cash is accumulating in the account already. So lots of times there's cash available to take money out or to buy other assets. So it's entirely up to you. It does take a little planning. If you do have a required distribution coming up, it's easiest to take in cash, but that's, and when you're looking at required distributions, your other IRAs may be able to make that distribution easier if they're still in the stock market. So again, your Uncle IRA with us doesn't have to be your only IRA. You can still keep some on Wall Street with one of those guys.
Perfect.
And then I've also had people do a cash out refinance on a property that's owned free and clear to satisfy RMDs if they didn't want to sell yet. So that's always an option to utilize leverage too.
Got it. Great.
Right.
Question for you, Bill. Does New Direction work with banks in states outside of Colorado?
Yes, any bank that is willing to lend to an IRA. We do have a list of other banks that we've seen lend to IRAs, but anyone can. It's just that they usually don't have experience with it. So you can certainly ask your own local banker and see if they're willing to, or call us for the list of national lenders too.
And it's a pretty short list, I would imagine. I haven't seen the list, but I would imagine there aren't many banks like First Bank. Is that right?
There are no banks like First Bank, of course.
Well,
but
thanks, Bill.
Yeah, yes, it is a short list, and primarily because most of the lenders out there sell the loan to somebody else, unlike First Bank that keeps their own money and their own loans in-house. And the selling of it is challenging for a bank because there's not a national market for those loans. So you usually need to find a lender that does portfolio lending already. There are probably three names that we see a lot, First Bank being one of them, and then North American Savings Bank and First something bank in South Dakota are the three, but we see stray ones come along all the time. It's an interesting opportunity for banks that do portfolio lending.
yeah, and it's again, from my perspective, all tied to the fact there's no personal guarantee, right, James? So that's going to shorten the list of banks willing to do this. So good on First Bank for stepping up and making this available as an opportunity. Okay, a question: do you ever look at short-term rents? How do you look at that, James?
Yeah, that's a great question. A lot of times what we like to do is qualify it based on a long-term rental because that's more sustainable. It can be operated as a short-term rental, but kind of as Bill has said, with a lot of the self-dealing rules, I've heard that can be a little bit more complicated when you need to manage it that closely. But it's absolutely something we can lend on and just judge it more on the long-term rent basis for a loan sizing standpoint.
Great. Okay. Another one for you, James. If I need to add more cash as a down payment, how do I get the money into the IRA if I need to?
So you still would be beholden to the, annual contribution limits, but you could roll it over. Bill might be able to speak to that a little bit more confidently.
Yeah, it's really where is the money? So lots of times people move the money of the amount they need, and then they discover they need to move more. So you just do another transfer in, and they can come from various different accounts. So if you look at all of your IRAs and you decide how much money you want to move, you get to pick how much comes from each account. And some people move extra for this sort of reserve, and some people move it as needed. But there's no limit to the number of times you can do a transfer. It's just that 3 or 4 week delay for the usually the other people sending the transfer over. But just build that into your calculations, whatever you're comfortable with.
Great, perfect. This question comes from one of our realtors, a Windermere realtor. Really good question. It's for you, James. Can buyers get fully underwritten for this type of loan before going under contract to be competitive within our market?
Absolutely. Yep, we'll do a full pre-approval, and it's really easy since we look at certain metrics for the plan participant to do that ahead of time. And we can kind of run numbers, and this is where having, a good agent is really helpful if they can provide us what they think the general rents that the property would command. So we can kind of do a more firm pre-approval and give people an idea of what they'll need to put down and what our loan amount will end up being.
Great, sounds good. Next question, if I own a current rental with about 50% equity, can I convert that to an IRA?
Unfortunately not, because that is your own asset. And the only way to get money into an IRA is via those cash contributions. So you could certainly refinance that property to get cash to make that annual contribution, but otherwise, that's one of those prohibited transactions, is taking something you own already and trying to put it into your IRA. So that would not be allowed.
Got it. And the same goes with someone owns stocks and they want to convert it to an IRA, or all the same rules apply, right?
Right.
Yeah.
Right.
Okay. I'll take a stab at this next question. You guys can jump in to help me if I need help. So, question is, how does the cash flow work? Does the disbursement go back into the IRA, or can it go to the owner of the IRA? Well, so the IRA actually owns the property, which means that the rent payments go to the IRA. They go to Uncle Ira. So Uncle Ira owns the property. Uncle Ira is who the rent checks, so to speak, are made to, which means that that's where the money is going, into the IRA account. Did I say that right, Bill?
Perfect.
Great. Good. So let's see. This question comes from another one of our realtors. He says this is a question from one of his clients. Do any paths exist to move into a property that had been owned by the self-directed IRA after retirement age? So you own this property in the IRA, you hit retirement age, now can you now live in it?
I think you'd have to distribute it out, Bill, is that correct?
Right. So Uncle Ira would give it to you along with a 1099 for the value of the property at the time, and then it's yours. So unlike money going in that has to be in cash, assets can go out. So if you have this property like the condo in Maui that you've always dreamed of retiring in, your IRA can buy it today, rent it out until you get to retirement age, then have it distributed to you and you can move into it because it's yours at that point.
Got it. Good stuff. I have to say, these are really good questions.
Yeah,
these are great. Okay, so here's a question. Sounds like this one is more for me. Is it? The question is this: is it better to start local, purchasing a property to be assured of rental income, rather than a mountain location? What I would say is that we're here to help you. So we're here to help you evaluate that. Part of what we do at Windermere, we run the numbers. We have really good, reliable ways to project rents. We have really good methods and literally spreadsheets built to help you evaluate what the cash flow is going to look like. So we're here to help you evaluate all those options. What I know about mountain properties, really depends on how they're managed, but you tend to see higher property management rates in resort locations. If you said mountains, so if you mean resort locations, you tend to see pretty high management rates, which can affect cash flow, but we're just here to help out. We can help you evaluate all those numbers. Okay, next question. I've heard you can manage your property more closely if you set up a company to manage it, and then it distances you a bit from the self-dealing rules. Is there somewhere I can find out more about this? Do many people do this, or is it better to just hire a property manager? Maybe, Bill, you can weigh in on that. Does having a property manager help you with the self-dealing aspect of this?
Probably about half of our real estate owners are direct managing. They manage it through us as far as sending checks and receiving rents, and calling the plumber and calling the maintenance person, making sure that Uncle Ira pays that bill. It can be done pretty easily online with our portal, so that you can go in and say, send Joe's Plumbing $100 for whatever. But if you're after convenience, having a property manager certainly makes it easier. It doesn't really affect the prohibited transaction issues, but it does make your life easier, because that tenant's not going to call you in the middle of the night. They're going to call the manager. So however much you want to be involved in the decision making day to day is entirely up to you. It's just making sure that that money goes back to Uncle Ira at the appropriate time.
Yeah. When I was listening to that, when I was listening to that question, it sounds like they may be thinking, Bill, about the LLC method, where they set up the LLC and have the checkbook control, versus having more autonomy that way. I think that's what that question was addressing.
Well, probably 10% or so of our investors do set up what commonly called a checkbook IRA. And in essence, rather than the IRA, Uncle Ira investing in the real estate, Uncle Ira is investing in an entity, and that entity is more directly under your control because you have a checkbook that you're writing the checks. So rather than having the checks come to New Direction, the checks would go to that LLC, and the LLC would pay the bills. And that is actually easier in some respects, but more dangerous in others, that probably beyond what we have time to talk about today. But we encourage people to look at what you actually need rather than trying to get that convenience, because you get a lot of convenience through our system already, and building in this extra entity in the meantime can cause issues. And certainly the IRS is aware of people writing checks that they shouldn't be writing from those LLCs. So
got it.
But either way works currently, so it's up to the individual.
Perfect. Great. And by the, you may have seen those comments. She was wondering about the LLC aspect. So good call, James. Okay, last question. We'll finish with a really good one. Would you recommend a current investment owner to refinance so those payments go into an IRA account to build up the possibility to purchase investment properties later on through the IRA account? Either one of you can weigh in on that.
So is it a property owned outside of an IRA, and they maybe want to do a refinance for some cash flow savings to then be able to slowly start making their annual contributions to the IRA?
That's how I'm taking it, yes.
Yeah, no, I think that's a great idea, really prudent.
Yeah. Bill, anything you would add?
We always encourage people to make contributions to get the money in there. Where they get the cash from is up to them. We're not encouraging one way or the other, but we do like, if you're going to start building, then earlier cash in is more beneficial, and also making those annual contributions once that real estate is in there, just for future expenses. It's the annual contribution. Once April 15th passes, you can't make that anymore. So getting more money in there is a good idea for tax savings, as well as having cash that you can do improvements and or buy more stuff.
Perfect. Well, I want to say again, thank you to both of you, James and Bill, so much. Very informative, so many takeaways. So thank you for committing the time today, the time to prepare. So appreciate it. We also appreciate everyone who joined us, whether you're watching live or watching the recording. means a lot to us. So what do you do next? Well, the next step, you can visit either one of these companies' websites to learn more. And really the next step is to engage with your Windermere Realtor. We're happy to show you the opportunities that exist in the market for this, to give you even more details about how it works to own investment real estate, and the opportunities. We can look at what long-term appreciation rates have occurred in our market, and what we're projecting for the near future in the market, and everything related to investment real estate. We're here to help out. We hope that you've enjoyed this. You will get the slides. Your Windermere Realtor will have those slides available to you if you want them. You'll also get an email in a couple hours with the recording to this, in case you want to go back and watch this over again if there are any parts you need clarification on. But again, thanks so much, James and Bill. We appreciate it.
Well, thanks for having us, Eric.
Thank you.
Yeah, our pleasure. And everyone, stay safe, stay happy, stay healthy. Thank you so much for engaging with this webinar, and hope to see you in the next one. Take care.